going to go ahead and call the meeting to order. We'll start with a roll call. John Bisher, member.
Matt Barker, member.
Pat Keogh, member.
Harvey Lewis, member.
Greg Williams, staff.
William Johnston, staff.
Brendan Vavrica, Anco Consulting.
Staff.
Very good. All right. We have agenda before us. I'd be happy to entertain a motion to accept as presented.
So moved.
Got a first, I got a second. All in favor, please say aye.
Aye.
Great, we have our agenda. Again, we have the minutes from our last meeting. If there's no corrections or deletions or additions, I'd be very happy to accept the motion to approve the minutes as presented. We got a motion? We have a second.
Second.
Very good, thank you, Dave. All right, our minutes have been approved. Presentations, we have Beryl Hanley will be here shortly. I'm going to go ahead and, Brendan, is there anything you'd like to kind of talk to? I know you need a lot more time to go through stuff. Anything high level you want to start?
No, not really. I mean, obviously I have a few different items to go through, but nothing of particular interest. If you want to skip over and jump to some of the other stuff, or would you like me to jump in?
I could discuss the environmental social governance issue.
Excellent, let's do that. Let's move that up to the next one.
So I included a presentation that we submitted actually yesterday to the City Commission Finance Committee, as well as a memo from the city attorney that was sort of drafted in conjunction with that presentation. And so we did, the committee did meet yesterday. It's a three-member subcommittee of the City Commission. And
the three members are who?
Sacco, Ward, and Hayes Santos. Okay. And so our whole presentation was in response to a March request that they had made. Because in March they discussed the Russian and Belarusian restrictions on investments, and at the same time they brought up the issue of, well, there are other things we might want to consider. I think their focus was on the socially responsible investing aspect primarily, where they might want to restrict investment in fossil fuels or gun manufacturers or things like that. And so we actually go through this with the commission probably every 3 to 5 years. We have for a while. And our recommendations are always generally the same, that staff recommends against it for a number of reasons, and you can see that laid out. The committee yesterday, they didn't take any action, which I thought was a positive reaction. They did request some more information about the various investment managers that the General Pension and Retiree Health Fund use, and how those managers might be incorporating some sort of ESG type analysis into their investment analysis and decision-making processes. So I've told them that we would go back to them at their August meeting and present them with some of that information. But I think our presentation, the reasoning within it, as well as the city attorney's memo pointing out their responsibilities, their fiduciary responsibilities, at least for a couple of the commissioners on the committee, that seemed to limit the action that they were willing to take or try to take. So I don't think we'll see what happens in August, but I'm less concerned about it after that meeting than I was before. I don't know how you feel, Mark.
No, I think that's an accurate description of what happened. Williams understating the fine line he danced in his presentation between telling them that the staff's position on how they should proceed about pushing them to make a decision. So yeah, I thought the fact that they didn't take any action on it, and the fact that they requested information that would give them a little more color and context, and maybe a little more position to say, okay, well, yeah, we're already, our managers are already incorporating some of this into their decision-making process, was a positive sign. It was the meeting went much differently than I supposed it might have. So William did a great job of diplomatically putting up a position.
and William did forward me a copy of the presentation again. It was really well done, and I think in conjunction with what I thought was a very concise and prudent interpretation by the attorney on the fiduciary role that our politicians and on one hat and then the fiduciaries on the other need to be aware of. I thought it was nearly incontrovertible in terms of, if you looked at the data,
Well, and, you know, we pointed out that a couple of years ago, the former city manager had sort of forced us to make some ESG type investments in the retiree health fund, and it had not turned out well. Now, you know, there's no guarantee that that's always going to happen, but it cost that plan a couple $1 million over an 18-month period. And, you know, if the same thing happened in the general pension plan, it's a much larger plan, and so the financial impact would be even greater. We discussed previously also the memo that I drafted for the PRC in response to the Commission's Russian and Belarusian investment resolution. That's kind of been moved forward a bit. It is scheduled we are scheduled to have an investment policy statement discussion on June 2nd, but that's related to the operating funds. I believe if we can get it done in time, that we'll take your memo to the City Commission at their June 16th meeting with respect to, you know, addressing the Russian and Belarusian issue with respect to the general employees pension plan. And so there'll be a board meeting of the trustees, which is the City Commission. So we'll try to get that scheduled for the 16th. I don't think there's any urgency in getting that done, and so I think we're still trying to coordinate with the city attorney on that because he wants input into that as well. So if it doesn't go on the 16th, then it would go sometime in July.
Would it be helpful later in the meeting for the PRC to pass a resolution or make a recommendation based on the ESG presentations and the city and the attorney's recommendation? Would that be something we can?
Sure. I mean, you know, if you like, you could ask us to draft a similar memo to the one that we drafted for the Russian and Belarusian resolution. You know, there's not a resolution involved at this point with the ESG, but we could still draft a memo pointing out the PRC's opinion on the matter, and you know, we could do that and then have you guys take a look at it and maybe approve it at your next meeting.
I think I can't make a resolution, but I think it's important that the trustees, for at least for the 22 years I've been involved, have, you know, taken the PRC council into consideration to make decisions, and this is an important, I think, policy decision, and I'm certainly, I think, if I were the commissioner, I'd want to know what my citizen-empowered board thinks about an important issue. So I think later in the meeting, we'll go ahead and pass a motion, we can draft something. So
Sure.
Want to go ahead and get back onto our stated agenda, but I appreciate that update, and I'm glad that things went well. So that's very good. All right. Well, welcome. How are you doing today, Bill?
I'm doing really well.
Okay, better than last time I called you. Had,
Yes, I mean, no food poisoning, no COVID, no anything. I hope, fingers crossed. It was a crowded flight. I was stuck way in the back of the plane. Flight delays. And,
So did you fly in this morning?
last night.
Late last night, okay.
Yeah, I got in about 11. So
I understand it's a very joyful experience traveling on the airlines these days.
you know, it really is, and I saw quite a few agitated people.
Yeah.
Yeah, no fights, no football players knocking people out. I saw that.
Well, we're glad it's good to see you here in person. So
Yes.
again,
Yes.
you're on our next piece of the agenda, so you have the floor.
Great.
As you know, we like to ask a lot of questions, so if it's okay, as you go through the presentation, we stop and ask questions. That's kind of how we like to proceed here. So.
Absolutely. Well, it's my 18th or 19th year presenting, so I hope I'm getting the hang of it. I want to say thank you for the long-term partnership. You know, we have a pretty good handful of clients with your tenure, and you're an important component of our success over the years.
And I have a question for Steph. The
Sure.
presentations, do we get those books for Barrow Hanley?
We just emailed them, we didn't.
Yeah, okay, we didn't print it, okay, that's
You
fine,
need
but
it.
that's why, okay.
I have an extra copy if you'd like.
I would love a copy if you can follow along if you don't mind. If there's any extras, anyone else would like to get a couple more on? That'd be great. Thank you very much. I appreciate that. Anyone else? Oh,
Well,
okay, well, great.
my name's Bill Underwood. Been with the firm 25 years, so it's right around the time that you all became clients, a little before that. You were insightful enough to hire a high-quality manager with a stated disciplined value investment process and philosophy. At the bottom of our relative performance cycle, recall that was right before the tech bubble burst. So we were on our worst performance period in our firm's history. And you hired us knowing that we stuck true to our style, and I don't think I have any other clients that I can say this about, but you did it again. A year and a half ago, 2 years ago, when value was out of favor, you allocated additional assets towards value when value was out of favor. Dividends were not discussed. They basically didn't exist when you talked about equity investing, and now they matter. Valuations now matter, and a year and a half, 2 years ago, we were talking to our companies, and I wrote about it in our quarterly piece. How can the Fed sit there with a straight face and say, yes, we understand there's inflation because of all of the trillions of dollars of stimulus, and it's a strong global rebound, but it's transitory. It's just passing through. When the majority of the inflation yet to come was through wage inflation, which is obviously sticky. I don't know about you, but it's not very easy to take back pay raises short term when you've given them out. And we saw a lot of our companies dealing with it well before the Fed even mentioned that it was an issue. So a lot of the companies in your portfolio had dealt with the inflation issue well beforehand, and that's why we think now, after the reopening trade, we made a lot of changes during COVID. We rolled up our sleeves. We were like kids in a candy store. A lot of stocks sold off indiscriminately, and we had some high quality names that we never thought we'd be able to own. And we loaded up the portfolio, about 40% of it on consumer discretionary, a lot of cyclical names, industrials, some financials like Goldman Sachs that we've never owned before. And now we've sold those stocks for the most part, and we are looking ahead for the next 2 to 3 years and seeing where the best value is, where the best bang for the buck is. Just a reminder, what we look for, low PE, low price to book compared to the market with a high dividend yield. It's much more complex than that. We look for, to narrow it down, stocks that are beaten up, which there's plenty of them out there, including the FANG stocks, the fan mags, Facebook, Apple, Amazon, Netflix, Google, it is Alphabet. But essentially, which of those companies have the wherewithal to get back to a normalized profitability? And what we do is we assign a probability to each outcome. And the ones with the highest probability of getting back to the highest earnings power they can, we rank them. And so the stocks that we end up buying are the ones with the most distorted upside to downside potential. So the upside potential has to far outweigh the further downside potential. So, times in recent history where we've thought there was a lot of upside potential, the downside, and that's what I love being about a value manager, you're buying stuff on the cheap to begin with. So it's a lot less painful when a stock goes from 12 times earnings to 10 than it is going from 60 to 20, like we see a lot of these mega cap tech stocks doing. Or, some of these unicorn stocks like Peloton, if they ever do have, sustainable earnings. And so that's what we do. We line them up and we say, this stock, advanced auto parts, used cars are the way of the future. There's a lot of pent-up demand for automobiles in general, but people are starting to do more and more of their own oil changes, etc. And in a recession, it works really well, and in a normal environment, it works well. But with Advanced Auto Parts, they were well behind the curve. They had a lazy management team. They had all kinds of low-hanging fruit, similar to Lowe's, where if a store in Dallas needed a set of parts, they would go to Arkansas, to their distribution center there, instead of the one in Denton that's 30 miles north, and get the parts from there, truck them over, inefficient as can be. And we asked why, and they said that's because that's the way we've always done it. And the new, distribution center in Denton hasn't been programmed into the system properly yet. Well, how long does that take? Well, it's been 5 years, so we hope in the next 5 years. It's like, wow, okay, some low-hanging fruit. So great industry, great opportunity to capture more of the DIY, but also the small mom and pop shops that do it for me, DFIY or DFIM, and that's what they've done. And we've seen that cycle play out largely. The stock was rewarded, and now you have this sell-off where value still is taking a lot of performance advantages versus growth across the board. And I would sum it up in two simple things. One, for the last year and a half and for the next 2 years, value stocks are expected to out-earn growth stocks. That means grow earnings faster than growth stocks at a cheaper valuation, much cheaper. And so what's happening now is you have growth stocks that are putting up okay earnings numbers. Tech stocks in general up 7% earnings growth. The problem is they were trading at multiples at low inflation and low interest rates that were in the 40s and 50s. When interest rates rise, that long duration asset of growth, that, hey, you promised me money 10 years from now, and I'm now going to discount it back at a 5% rate instead of a 2% rate, all of a sudden looks really expensive. So they bring the valuation down. And so the vast majority of the performance loss that you see in those growth stocks is a re-rating downward of PEs. It's exactly what happened after the tech bubble. It's exactly what we're seeing now. So we've expected this. We've been talking about it. We have some charts in here. And before I really dig into the portfolio and how everything I've just mentioned impacted performance, quick update on the firm. There's really nothing to talk about. Jim Barrow officially retired at the end of the year. By retire, I mean he's coming into the office most days in jeans, and he loves what he does. He's just not going to pull him away. And he loves mentoring. He loves talking to the younger generations of the firm. I don't think his wife likes him at home much, so he's still there, and he hasn't been managing, much in assets for over 5-6 years. So he just enjoys what he does. But he officially retired. We have brought on 4 new analysts to cover emerging markets, to fill in some gaps in our non-U.S. and global strategies as well as domestic strategies. So we're growing. Perpetual bought us a year and a half ago, and they're doing exactly what they promised. They're leaving the investment teams alone. We launched our own mutual funds, believe it or not. So we now have our own line of mutual funds. We've had a lot of consultant-driven demand for having lower minimum mutual funds that are, easily accessible to, institutional size clients with a higher minimum than a retail fund. So consultants and clients that want to move in and out quickly and make those decisions quickly are now able to. So we have that in diverse large cap value, global. We have a ESG strategy and an emerging market.
Now, are those branded under the Perpetual brand or under Barrow Hanley?
They're under a Barrow Hanley brand.
Okay.
So it's our first branded mutual funds in our firm's history, but none of it is in-house. It's all done through Perpetual and SEI. So they've worked
Okay.
together to help us put that together. I think we had 200 million kind of right off the bat in a couple of the funds and 200 million in the non-US and global funds. So it was break even from day one, which was great. We shut down the commingled fund in large cap value land and created a CIT. So we now have a CIT available for clients that need a commingled asset or a vehicle. And commingled funds were a little archaic, so CITs are kind of the next generation of that. And I just need to inform you that there is a 35 basis point fee on all new assets up to 200 million coming into that fund. So the clients we did switch over that were on the smaller end, I don't care about size, they're all clients to me, but you know, a lot of them got a fee break by switching over to that. I think you guys are, at your size, are well below, or you know, at least at that 35 basis point type of range. I know any new assets coming in are at 25 or below.
So just so I understand, it's sort of the plumbing, so SEI is what the custodian, they're doing some of the back office operation, Perpetual,
It's helping
hard to get, I mean,
distribution wise, they've
Distribution, yeah.
hired the people that will help our team go out, and so we won't be talking to all the wirehouses. We've hired people to do a lot of that legwork. And so they've worked with our distribution team and with us and going out there and telling the story.
So the investments of those funds are a replication of what you're doing already at the institution?
Precisely.
Just different format?
It's essentially just a different separate account.
Yeah.
It's just there's a lot of underlying holders of that separate account.
Exactly.
Gotcha. Okay.
Exactly.
Fair enough. Thank you.
Mhm.
And one other question, you mentioned advanced auto parts, I don't, but you mentioned, obviously, you have people who show up there and you do, get the oil change and switch out their battery and so forth. You say they also do a lot of business with smaller mom and pops, where they're basically the supplier of goods that are then
Yep, same day delivery. They've got, you know, their list of clients that, you know, Smith's Auto Body 2 miles away, you know, calls them about 11, says we need, you know, these 18 parts.
Got it.
So they load them up in a truck, they head over there. It's a great, steady, long-term business. It's growing. And they were starting to lose share to, you know, the, AutoZone or O'Reilly's,
Okay.
only because they reshuffled their sales force away from that. The new management team said that was a horrible move.
Mhm.
Let's go back in and let's go stronger, because that's a big chunk of business. That's 60% of revenues. And so they did, and they've not only taken back the share, but they've grown that share. And so, you know, just by rearranging some things, reworking, you know, 6 systems, inventory systems down to 2, just a lot of blocking and tackling to become much more efficient. And, you know, Lowe's was its own story with Marvin Ellison coming on board. That story has played out, but there's still a lot of headroom for Lowe's to keep going. They used to be crushed by Home Depot quarter after quarter, and they had 35% less sales per square foot than Home Depot. And Marvin Ellison spent 12 years at Home Depot turning it around. So when he went over to Lowe's, he was ready to retire. This opportunity presented himself. He does not need to be there. He wanted to be there. He was excited to be there. Home Depot's not very happy, but he brought over 12 of his best people, most of the management team. Playbook, open the playbook, he's just hitting each page, boom, boom, boom. Couple of hiccups here and there, but for the first time in a decade, they beat Home Depot 6 quarters in a row in same-store sales. And similar to Advanced Auto Parts, Lowe's was really the consumer's place to go, whereas the pro was going to Home Depot.
Right.
Why? They had food carts set up. They had, you know, pro days. They have a pro system where you get rewards. Home builders get rewards for using Home Depot more and more. And Lowe's is learning and replicating that and gaining some share in that space. So, and online is much stronger than Home Depot's as well. So,
Cool. Thank you, Jay.
yep. So you kind of have seen we're coming off of a very solid 12-year bull market with some volatility, and with the exception of energy, the world seems to be falling apart. As we look at the market, I'm looking at page 14 and 15. So if we look at page 14, we get tired of beating up on growth, because values as a standalone is a great investment right now. Just standalone. When you look at growth versus value, this top left chart, this is just growth less values, PE. So we were at a 15 multiple point spread at the peak. And so when the pandemic happened and we were close to we were at a new all-time high, none of us expected that May of last year for the Fed to kind of go, there's a growth scare, we're not going to raise rates very quickly. So then tech had another run back at value. Same thing happened after tech bubble burst. March 09 of 2000, tech rolls over, value gets a 22% head start in a couple months. Exactly what happened here. And back then, growth came back. There were all the believers. Hey, tech made me a lot of money. This is a buy opportunity. And they drove it back up. That's exactly what happened. They went to parity again. You can see that peak at 15x, multiple points. And now there's a roadrunner type of cliff that you're looking at, where to get back to even close to median, even halfway to median, means growth has a lot further to fall. Means their valuations were so high because all of the money sloshing around in the market, low cost money, all chasing the same ideas, Bitcoin included, very, very, high risk investments, along with the unicorn stocks like the Pelotons of the world that, I don't know any other company that was resting on just, a user base that was willing to pay $40 a month to be a part of this little group, because you see all the knockoffs coming along at 40-50% less, or this almost the same exact machine without the network or the fees. So that's taken a chunk out of them. But a lot of these companies are deflating, let's say, in a big way. So you have that multiple compression on the value side. They were right near their historical average. It was at 16 times and then went down to 15 times. So growth during the last quarter went from 32 times down to 26 times, and their historical average is 18. So you've got a gap like that left, whereas value is like this. And that's just average. It's gone below plenty of times. So we're watching that. We're looking at, yes, the market was pretty frothy. They ignored the Fed's willingness to stick to their approach and to say, we are now fighting inflation. Because inflation, if they don't get it under control, is something you don't come back from for another decade. And really their kind of line in the sand was 4% on a CPI, core basis. They also look at PPI, and we had shot so far over that, and it didn't roll over as quickly as they thought. And that's why, despite the market sell-off, despite signs of global growth slowing, they're going to march ahead and keep raising rates, because when you get over that 4% bound, it's very hard to reel it back in any reasonable time frame. And that's where you hit stagflation, which we're pretty much in right now, and we don't want to be Japan, essentially. So they are going to continue to raise rates. It's going to continue to help value, and within value, there's still a lot of growth stocks that made their way in. 85% of the Russell 1000, so the broad market index, they split into growth and value. It's done on a market cap basis. We hit a new record of 85%. So 850 companies were in the value index, and there were 450 in the growth index. And you're like, wait a minute. Are all 850 of those value? No. I mean, you had Uber, Lyft, Twilio, Zillow, and you're like, okay, it's killing us in the short term, but in the long term it becomes an easier hurdle. So you kind of have to, let your clients know, look, we don't look as smart as we are right now, but we're not as dumb as we looked a year and a half ago because we wouldn't own these stocks. So since the bottom of the COVID market, your portfolio has gained about 17% cumulative. So it's been just a little over 2 years. We've cut that in half on an annualized basis. When we look at the quarter, 1 year, and 3 year, it doesn't really capture that 2 year. But that's really the inflection point. That's really when we started to outperform. So we are outperforming. We see nothing but a lot of similar situations ahead. And as long as inflation, expectations don't stay that high forever, it won't impact as much our portfolio of stocks because the companies have raised prices, they have pricing power. There's a few one-offs like Stanley Works that they hedged out some steel costs, some production inputs that have stayed higher than longer than they expected. But one thing that the tariff and the trade wars did for a lot of these companies is it allowed them the opportunity to source multiple places. So it preempted China having all the control, through this whatever policies they're going to, go after in the next year, 3, 5. A lot of the companies have moved to Vietnam, to Mexico. They've expanded their distribution network, which just helps ease the pain of any one. Global supply chain still not moving like everyone would like. With the Russian-Ukrainian war, that's obviously not helping. But for the most part, the wheels are starting to come, unrusted from the tracks and is starting to grind forward. And no matter who you talk to, what industry, there's a shortage of something. I mean, you go to the gas station, there's a shortage of Twizzlers, and I'm like, when are you going to get more Twizzlers? I guess it's less important to have Twizzlers than it is to have semiconductor chips for Ford F-150. So
You mentioned earlier, you said that you talked with some of your clients during the pandemic, and they were always seeing wage spiral impacts, and I'm just curious, when I read it, that's continued, but how are they managing that in terms of, obviously, if pricing power, you can offset some of those input costs with higher fees to your end consumer, but how did they manage that? Or did they just have to cough up more money? I mean, I'm just kind of curious.
yeah, so with margins as high as they were,
Yeah.
and then with cash on the balance sheet at all-time highs, and they were all, a lot of these companies already paid a significant dividend that they were growing.
Right.
They still had a decent chunk of cash that was just sitting there, lowering their return on equity, their return on assets, and when that happens, management goes, what can we do? So essentially, they're looking at it going, okay, so we have, because we've been able to raise prices, not as much as all costs have gone up, but most of the way, they feel pretty comfortable because at some point, and we're starting to see that in some, with lumber and other things, it's rolling over. They're going to meet somewhere, and then the cost pressures on the input side will decrease, and wages will probably stay flat and just increase with inflation. I remember John Deere, that's a big holding of ours. We bought that 4 years ago, and our analyst identified this precision ag thing that the street didn't start talking about until 2 years ago. And this was a technology company, it wasn't a tractor company. Now they have self-driving tractors that can, plant the seed depending on the humidity and the moisture in the soil and the weather for the next week. They take all that into account, and it's a 6 to 9 month payback for the farmer. 6 to 9 months is all. I mean, it's a cash cow. They have high-class problem of figuring out how to price this thing, because they're not charging as much as they could, and they certainly have a lot of room to raise the cost of it, but they love, that the farmers are seeing immediate payback. They're making money hand over fist. They were stuck at 26 billion in sales for 7 years. I mean, that was like, you'd watch tractor sales go like this, and now they're going like this. And the used market was very expensive, just like motorhomes or cars. And they came out this last quarter and said, orders are down. And when you dug it, the street immediately, sell. It's people are walking away, they're too expensive. That's not it. They can't book a sale. They have a bigger backlog than they've ever had in history. They're a 9-month backlog, so they can't book a sale because these farmers have to put down money to get their place in line. Once they deliver that combine, that tractor, then they book it as a sale. So it looked like their sales were starting to taper off, but in reality their book was building. So down the line it's going to jump back up, and the sales will show up on the income statement, and it'll drop right to the bottom line in higher margin sales, because the sell-through has gone from 60% precision ag enabled to like 78. They're expecting 90% once the farmers get to see more of this data. The more you have, the better your yields are, the more you make. It's a self-fulfilling, very virtuous cycle, because their See and Spray technology saves 90%, 95% of the chemicals that are being sprayed on crops. Less chemicals being sprayed into the earth, less cost for the farmer, better yields, win-win-win, ESG, high marks, and it's just a great story overall. Has nothing to do with farming itself and building a combine. Has everything to do with using the technology that's out there, which we see across the board. And these hidden assets, these sleepy companies, 1867 founded company, who wants to talk about that, building this from scratch, hiring the right people, making small bolt-on acquisitions to where they have this huge John Deere center now. It looks like the Pentagon, where they can see the weather conditions all over the world and all of the tractors that are reporting back. And it's like, this is no longer just a manufacturing company. This is a data and technology company. So, story after story I could show you, all while maintaining our value discipline. Page 18, we're still at a 20% discount to the market. Price to book becoming less and less relevant with all of the acquisitions over time. Intangibles build up on the balance sheets. And as a reminder, Russell uses price to book to delineate growth and value. That's where you're getting these distortions, where Uber and Lyft show up in the value index. So EV to EBITDA, that's another measure that we use in place of price to book, and a dividend yield premium. There could be a 10-year period here where dividends are most of the return. That happened back in 2010. From the tech bubble looking forward 10 years, you had a dividend yield that was all the return that you got. So could be more important. We think it is. Graham and Dodd were not wrong. Neither was Warren Buffett.
On the dividends, take us inside a little bit. As you've transitioned to value, how do you buy? Do new traders just target a price and put a limit order in? Or?
Sure. And I'll tell you, that's been interesting to watch, because the first generation of Barrow Hanley has retired. Barrow Hanley, William Strauss, Englander, that all started the firm. Jimmy's still there, but he's not running any money. And from the beginning, it was obvious to us that when you put a governor on management, where you're taking away half their cash flows to go make stupid acquisitions, they have to think a lot harder about what they're going to do with that cash, right? So we've bought companies with zero dividends, but high cash flowing companies that have the potential to pay a dividend. and have been signaling to the market that they will pay a dividend. And some growth companies are scared of that because then they get thrown in the value bucket like, oh, this is mature tech, this is mature, it's got to pay a dividend now. But in 2006, everything changed because they said, you know, stock options are no longer options, they're going to be restricted stock. So when a management team now votes for a dividend increase, they just voted themselves a pay raise. So dividends as a payout ratio kind of went up a little bit, and then as margins grew, dividends didn't keep up and they're still low.
See, what we're finding is that buying into value using options out of the money puts really enhances the returns,
I can see that.
particularly in a volatile market.
Right.
You know, what's going to happen today or tomorrow, putting in out of the money put orders. Well, because you've got a wide, I think, you've got a wide array of value stocks that you're looking at, and putting in below market orders effectively on a put basis really does improve the return.
And we've thought about creating an alternatives arm to barrel handling, but we've done just fine on long-only investing, and we have heavily restricted our personal trading of employees.
But when you
without that,
when
and
you target a
Mhm.
an auto supply company or
Sure.
something like that, right? And barrel handling's going to put it in his portfolio. Do you put a limit order in?
So we trade, anywhere from 2 to 10 million shares a day. And so it's the traders and the PM's jobs to watch the stock activity. And they will put a limit order in, they'll put in, stop loss provisions on certain trades. They'll say, if you can get it at X, get it at X. If you can get it at X plus 10 cents, do that, but don't go above that. Or they'll say, this thing's just blown out cheap, go ahead and buy me up to 1.5.
Putting in a put option on something like that, where at below market price, you can earn a premium. So
Right.
the premiums are really high.
Right, because the delta's so
Well,
large.
because of volatility.
Yeah,
And,
volatility
but if you've
does
already
suit it.
determined that that's what you're going to go after, and you kind of know the price range, why
yeah.
not sell a put on?
right. Well, we have a lot of, almost nearly all of our IPS and our guidelines from our clients
Mhm.
state we're not allowed to trade options.
Really?
So, by design, because could you imagine in '99 or in the financial crisis, what would have happened to a lot of those? Would have been out of the money, worthless. And it's fine, you're right, there is some extra juice to be squeezed out.
Yeah.
And what I was about to say was, we have, people that were at hedge funds before, hated the quarter-to-quarter thought process, moved over to long only. And so we have portfolio managers now that trade around positions a lot more than we used to. It was long-term thinking, long-term investing, but there's a lot of data that can be gathered.
See, I'm not
by-
suggesting trade.
Right,
I'm
right, right.
suggesting just as a technique to buy.
Sure, sure.
As long as you're going to buy,
Yeah.
why not buy it?
I would say we might be 10 years away from that, where clients get comfortable with allowing us to do that, but we're a long ways from that, to be honest.
Typically, that's not, in kind of institutional portfolios, that is not utilized except for, option portfolios or alternative strategies. That may be a component in that bucket, but it's typically not done in traditional long strategy, separate account type scenarios.
Yeah. So we're limited to, no more than 5% cash, keep you fully invested. We're not, we haven't been known, we could tactically time it, probably get it right 60% of the time, 55% of the time. But the second you get it wrong 60% of the time, you're going to hear about it. And that's why we just keep you fully invested. You've seen the charts where if you miss the 10 best days in a decade, your returns are down by 20+%. So yeah, that is true. You can, if I were investing my own money, I would certainly look at doing it that way. Especially when
Yeah, because you got the targets.
When the prices
you
are-
know
yeah.
what price you want to pay them.
sure,
And why not pick up
The
the
premium.
premium on putting in the order? If you're gonna put a limit order in, why not put it,
Sure.
money put?
sure. But it is interesting along those same lines, as trading and the information, we get a report every quarter and the PMs will go in and we'll talk to them about it. They're focused on the stocks and, the stock movements, they're very acutely aware. And so if a stock sells off with the rest of the market or the rest of the industry because another company reports a poor number, I mean, that's a great opportunity to add slightly to it. You could add 20, 30, 40 basis points. Whereas historically, we just watched that and we said, uh-oh, that stock got hit. We now think, 2 steps ahead instead of just one. And we say, this is an opportunity. We were going to add to this position anyway. Let's take this opportunity because the volatility and the ability of those stocks on an intra-sector basis, correlations can go up, intra-sector correlations, and the stocks move together can go up quickly and they can also fall quickly. So, by our lights, it looks like about 70 basis points we've been able to add over the past several years, just in trading more intelligently. So, everyone's using technology. We're not taking any risks with it. We're just using it to make sure that we're getting the best price and getting into a stock at the best levels. And, let's talk about, performance here on page 20. Except for the 1-year basis, we've got a nice run here at, 3 years at 14, 13, 6, 7 versus 13, 5 years ahead, 7 years ahead, 10 years ahead. And just to note, as we roll off a couple of bad quarters, these numbers are going to jump a decent amount. If I were to put a 2-year number in here, which they said I wasn't able to do, even though we have a fancy new system to produce these, I said, wow, this is great. Because the 2-year number would show us about 6.5% ahead of the Russell value. So it still has added to our short-term and medium-term performance. We expect more of the same. We haven't reached even maybe the second inning in this value run would be our guess. If you look back, and there's a chart that I'll have you flip towards because it's just such an interesting chart on page 30. In the upper left-hand corner of page 30, this is every value run after a growth run. This goes back to 1930, 1932. And I also created one of these with just one line, average line. And so you usually see this pretty strong run, you see a little give back, and then you see it keep running. But the average is about 7 years, and it outperforms growth by 120% cumulatively. So we're now back up to about the 20%, 24% line. And, we shot out of the gate after the vaccine announcement with the economy reopening. It was a very solid 5-month run before there was a growth scare and rates fell. So there was a postponing of the value run, but we're right on track. And there's been weeks this year that we've added 200 basis points a week. So we like what we're seeing. We're in some unique areas that we haven't been in before, like material stocks. Some of the best margins and margin stability, even through COVID. So out of all the sectors, when you look at their pre-COVID to bottom of the COVID market, materials only went down 9%. So you still needed, all of these different air products, we've owned in the past. You have all these unique, smaller aggregates companies, that's just the raw inputs to a lot of things. And so those have been fairly steady. They've been able to continue to produce and have surprised on the upside a lot. So in the sell-off last year, we took advantage of the weakness to buy into some material stocks. And then switching to attribution, if you'd like to see kind of what's been helping and hurting, we'll just go to the year on page 23. Technology, interestingly enough, #1 contributor. So they, from what we've seen, a lot of people were giving up on Facebook and Amazon and moving into mature tech like Broadcom and Qualcomm, some of the names that we've owned for a while, and waiting for them to get recognized as solid, double-digit earnings growers. Oracle, we're selling out of Qualcomm. Cognizant, they're big into 5G. Cognizant Technologies, Fidelity National, FNIS. It's like a servicing organization. So mature tech, we were up 24% over the past year. The market was down 4.5, and included in that is a lot of those, Zillows and Twilios and FireEye and the no PE companies with no dividends that were added. That'll probably make their way out of the value index at some point, but financials, we moved back into some of the big money-centered banks like Citigroup and Goldman Sachs was the first capital market stock that we bought, during the COVID sell-off. We sold that this past quarter.
Are you looking at, is
I'm
there a
looking at-
transaction? You mentioned Qualcomm, you're selling some of those you're purchasing. Is there a chart that shows what you've been selling and adding?
It does show you on page 24, and they're asterisked on 22 and 23 if we sold out of them.
Okay, gotcha.
So yeah, we sold Chevron out completely.
Okay.
And then on 24, the new holdings are asterisked, and then underneath the cash, it'll show you the eliminated. So that is, Citigroup I mentioned. General Dynamics we were in for a short time. Goldman Sachs, Jacobs Engineering Group, very cyclically oriented construction firm that's basically a technology company now. And then the banks like Citi, JP Morgan Chase, Sallie Mae's a student loan lender that did well off of the move up in rates. Lennar we made a lot of money in and feel pretty comfortable moving out. And then with General Dynamics and Raytheon, just the defense overall, given the unrest around the world, had a decent move up and we sold those. And then on page 24, some other, as I mentioned, materials is a sizable overweight now. Air products and chemicals we've owned before. Corteva, DuPont, those two were really, when you looked at DuPont and the merger that they had, Corteva is the seed company that spun out of it, that they took, the best of both worlds, and, they have, along with, the John Deere kind of hand in hand, the seed technology is getting so much better. Their new Enlist is basically the #1 product by far. When you drive through the Midwest, most of the fields planted, you'll see some Enlist plants out there guaranteed. And those are, again, the need to reduce the amount of herbicides and pesticides. They keep coming up with the best product, the best mousetrap. Within financials, we've slowly lowering our weight. We've had a lot of movement up in rates. M&T Bank is really based out of Buffalo, solid regional bank that, you know, they made it through the financial crisis, smelling like roses, and have just been plugging along. So it's companies like that that when banks' earnings came out and they kind of lapped a difficult comparison and then showed contraction in sales and contraction in net interest margins, people thought, oh, well, they're not making any money. But the moves up from here in net interest margins will be very, very large. And so I think it got ahead of themselves, the financials in general. You'll see more insurance stocks than you have in a while. AIG, Willis Towers Watson, Allstate, those are all companies that obviously are going to take advantage of, you know, the investing environment and pricing power on top of that. Energy has been a solid area for us. We've kept Hess and Phillips 66, added Pioneer Natural Resources, each for unique reasons. We're not in energy stocks because we think oil's going to stay high for a while. We're in them because these are companies that maintained and grew their dividend through the down cycle, and then through this increase, they have cut back on CapEx. So the typical cycle of make a lot of money, spend a lot of CapEx, just pay a normal dividend, they're paying special dividends, they're paying increasing dividends on top of smart capital allocation. Hess by itself is a unique name, and when it sold off, you know, early on in COVID, when, you know, oil hit the skids, it was just amazing to us that the investor base, they weren't investing in Hess, they were investing in ETFs. This is one area where I can honestly tell you passive investing is helping us do our job and helps us find tremendous dislocations, because when they trade these ETFs like energy or real estate or what have you, they're selling everything and everyone's dumping the same stock. And Hess is partners with ExxonMobil in the largest find. They found a Saudi Arabia under the ocean in offshore Guyana, just right near Venezuela. It's, you know, it was a gamble. They're a 40% partner. They've got cash flows coming out their ears for the next 10 years. I mean, this is like a gold mine, and the gold is there. It's been seen, it's recoverable, and they're just slowly finding it, capping it. They're going to start pumping it, you know, when the time is right and when the returns are best, and they'll slow it down and speed it up depending on the price and demand. So, you know, along with that, there's Pioneer Natural Resources. It's a company that we watched slowly through the financial crisis. They're in the Texas Permian Basin. They had, you know, some big chunks of land, but there were two companies that owned in between their acreage quite a bit of land where they could only use 30% of their hydrofracking and their horizontal drilling technology. So when everything sold off, they went and picked those two. Just the street wasn't paying attention right away. When they came out and they showed the map of what they bought, they now have contiguous acreage that they're going to be able to use 80 to 90, almost 100% of their horizontal drilling technology across the board. And just like that movie, I don't know if you all saw it with Daniel Day-Lewis.
Oh, yeah.
With the straw thing, it's the same situation where it's like they've got a big straw that they've got to drill straight through all this acres without drilling another well. They'll have some sister wells for pressure, but they know it's there, and it was a brilliant move by them, but the street wasn't paying attention. And so they've got some great production profiles locked in. That's what we do, just one at a time, find them.
Why are they not drilling now?
Oh, they are.
Right now, the ground now. Is it going to get better
They
at
can-
108?
They could definitely turn on the spigots even faster, but every company that we talk to is being very cautious, because the second you turn that on, you're paying oil services companies that day rate to be out there helping you make that happen. And those rates have gone up with the price of oil, just like they did in the last super cycle, when oil was 140 plus. And it's interesting, contracts hold in every other area except energy. You have contracts, it doesn't matter if it's here in the US or in Venezuela or Colombia. I mean, they just say, no, we changed our minds. We're going to write a different contract. Sign this, and it's the same with oil services companies. You could have a 5-year lockup guaranteed. You know, we're going to pay this day rate for for this set and this set of technologies, and get these services from you. And the moment it goes up 10% past that, they go, we've changed our minds, and they could make it, just like pilots on strike or mechanics on strike. I don't know if you saw that, but they can make up a lot of problems on why they can't get to your well site. And it's the way the game is played, unfortunately. But yeah, they will open up the taps, but they still have a lot of capped off capacity. They don't want to get ahead of themselves and end up paying storage costs or paying the rates of a $90 oil services costs, and it drops down to 50 or 40, and they have to pay that same rate for the next year and a half. I've taken up a lot of time.
No, this is always informative and appreciated.
Yeah, and
You said that you thought the Fed's going to continue with the rates going. How do you think about the impact on the federal deficit when you got $30 trillion worth of debt and the things going up and the base rates are going up 50 basis points a quarter?
Sure. Well,
I mean, at some point, doesn't it just sort of dominate the federal budget?
it absolutely can. And if you look at the forecasts, the risk of us hitting a stagflationary, basically low to no growth environment on a real basis is a much greater risk than having some slowdown and some potential for higher taxes down the road, for something to have to give fiscally. So, in other words, it took, a lot longer to get out of the late 70s, early 80s inflationary era. You have to grow out of it. You have to grow the economy. And by raising rates, they're signaling to the market that, hey, financials have been cheap for a while. They've been overcapitalized. It's time to put that money to work, and we're going to continue to raise rates so banks can continue to loan. And we're seeing, obviously, you'd think this would not be headline news for another decade, but a lot of subprime borrowers ended up with the same stuff they did: used cars, jet skis, mobile homes, through this past cycle, and you're starting to see those 60-day late, 90-day late numbers tick up. That's a sliver of it, but for what the Fed is looking at is, if we hit that 4.5%, red line that they want to stay away from, which happened in, late 96, that's what GNV-SPAN was staring at. And anytime we've gone above that on inflation, it's really, really difficult to reel it back in, to get it to a level of 3.5 or 3%. And forget wages. We're going to have a lot more problems than just wages if inflation stays above or at a 5 or above level for years. It's not going to be pretty. And then you're talking devaluing the dollar to a point where it's a joke. So. Sure.
Something's come up again. You have a great section, I think, starting on page 32 is your ESG rating.
Sure.
Particularly 34 and 36 might be something we need right now.
We started back in 2016. We went in eyes wide open. We made an investment prior to any really requirement on our end, and decided to create in-house our own ESG group. And Louis Ropp, who's one of the large cap value PMs, is on our ESG team. Ross Campbell, we hired him back in 2016 to be the portfolio manager on this. And we have a US ESG strategy, but just earlier this year, and this is one of the advantages of Perpetual, they helped us get into a search in Sweden for a $500 million ESG global. We don't have an ESG global strategy, but they liked what we had put together and have been doing on global. Same analysis where we have 60% of the score is internally generated, talking to the companies. 40% is using the MSCI Sustainalytics number, and it's worked really well. So our ability to talk to management, to affect change, they come to us now talking about how can we improve our, the way the street looks at this. And we take a look, we meet with the board members that we need to, and it's become a very symbiotic relationship with a lot of management teams. So we are in ESG, we're not a check the box, we don't do things that way. So now we have a global ESG strategy that's funded. If you are at all interested in ESG, we have every flavor you can think of as a strategy. We do utilize it in this portfolio. It's not a binary buy-sell. It is an input that's given serious consideration. It has kept us out of some names, and it's helped us, kind of be the deciding factor on a few other names. But for the most part, it's not a binary buy-sell, because we want to make you the most money, and there are companies in here that are C-rated that we think are going to be B+ or A-rated someday, because they're making the changes possible to get there. So we're heavily into it, we're fully invested in it. And yeah, we were able to, there was a working group of consultants that came out with 12 metrics that they expect every manager in a couple of years to be able to report. We were able to do it in 2 weeks because we had all the data. Down to the point of, and I don't put the pages in all these books or else they would be really thick, but we can tell you your carbon impact, per TCO squared, of the stocks in your portfolio. So we could narrow it down to just City of Gainesville's impact on the environment from our portfolio, that pages that look like that.
Just to give you some
Please don't.
perspective. Bill,
Yeah.
Harvey mentioned that because we were having a discussion earlier. The Gainesville City Commission they do this about every 3 to 5 years. They've expressed interest in, exploring the potential for ESG investments. And, staff's opinion, and I think the opinion of the city attorney and some other people, is that, we don't really support ESG focused investing, like a fund or something of that nature. And part of our argument is that our investment managers like Barrow Hanley are already considering these factors to a certain degree. And so moving forward, they've asked us to come back with more information about that. So I'll be contacting you and our other managers to ask what processes you have in place, and you've already, gone through it here. But that's good feedback that we can give to them to let them know that you don't need to buy an ESG manager. You've already got it. For the factors that are important, they're already being looked at and considered.
Precisely. We've been around 44 years. We've been on the S and the G side for a long time. The environmental factors, this data is just now becoming more and more prevalent. We work with companies like Carnival and, ConocoPhillips, Phillips 66. They come and talk to us about how to best present their data that they have. So, Ross is speaking at conferences all over the world. Be happy to bring him in sometime too to talk about what you just said. What's the point of an ESG only strategy versus a strategy like ours that has a full rundown of every ESG potential problem, issue, what they do well, what they don't do well, how could it impact the portfolio, how could it impact the investment long term? Is it looked at? Yes, absolutely. Is it discussed with management? All the time. Every call we have with management, there's an ESG topic. And I think you're absolutely right. If you end up with an ESG portfolio only, you're going to end up with a very large chunk in technology. By the way it's designed, they don't have much in the terms of oil or, emissions. So you have to be careful. And there's a lot of great companies that are rated C on their way to an A. You're just catching them in a point where it's now important to focus on these things. And they've never had to deal with it before. Even though they're, doing an okay job at it, they can do better. But does that mean they're a bad investment? Absolutely not.
I thought it was a great summary of your strategy on this.
I will, these are brand new pages we just came out with because the data just came out on what they were going to look for, and I'll take that back to the firm. They'll be very glad to hear it.
Yeah, I do have a question. You've already danced around and talked about subject a little bit, but stagflation, recession, all that good stuff. I mean, when's the last time, or in your view, have we had unemployment at the level we've had it and had a recession of any sort? Is my first question. The second one, and answer however you like, is to stay under that 4.5 number that you keep talking about, or get under that, I should say. What are you guys looking for from the Fed, from the capital markets? What are you wanting to see to give you some confidence that we can actually do that and get there?
Sure. So, what do we expect from the Fed? Very little. I mean, not a lot of confidence. What did Churchill say? When all other options are exhausted, they'll do the right thing. I mean, you just look at them and you go, can you honestly look at us with a straight face and just ignore the inflation that's there and say it's here for a bit, it's moving on out. It didn't transit anywhere. It was here. They knew it was here. Wages were already moving up. And wage inflation is sticky. What we look for, that the 5%, 4.5% is kind of the buffer zone. Every time inflation has gotten over 5% on an annualized basis, we've had a recession within 2 years. Every time inflation on a CPI core basis hit above 5%, we've had a recession within 2 years. We've just had a very strong economic rebound driven by fiscal stimulus and monetary stimulus of every sort. Way too much, in our opinion, that was not necessary. Now you have the consequences. You've got people that overspent. You've got people that a lot of money put into work in the asset markets that are driving valuations up. Now they're pulling it out. Valuations are dropping, and the economy's going to grow. The economy's going to be just fine. Our companies are not signaling any concerns. They see strong demand.
Do you think that's due to the wages that we just talked about? Because that's the thing
Wages have to come at some point, when
I can't understand how we have unemployment at the level it is.
Yeah, it's.
And consumer spending at the level it is, and
We-
that's where I'm.
We had a period of unprecedented productivity post the financial crisis where wage and job growth was well below bound the normal growth rate for a long time because companies have been scared of another financial crisis, and COVID happened to be that crisis. So the companies that were just really concerned and holding back on full expansion said, see, we told you we had to be careful. Then the government said, hey, we're going to basically pay you to hire people. Who's going to turn that down? Hey, we've been waiting. Now you've got Amazon overstaffed. And they've got really they don't want to be the poster child for layoffs. They're in this tough situation because they were out there saying, hey, $15 an hour minimum, $18 an hour, health, dental, come on, work for Amazon. As it slows down, it's great because the equity markets love the stock. Equity markets were saying Amazon's going to the moon. it was priced like that, and now it's gone nowhere for a year and a quarter. And it's been negative. And now they're rethinking profitability. Before, they didn't have to think about profits. They had investors that didn't care. Yeah, and so the wide swath of companies that we follow in the real economy, the actual economy that's building, making stuff, consumers that are buying stuff, is doing just fine. We're going to grow it at above trend here for a couple of years, but if inflation gets out of control and all of a sudden
Isn't
it's...
it already then?
Well, this is, remember, we were going to have a spike in inflation regardless with all that money flowing in, and now it's all chasing the same goods. At some point, the gears start moving in the global economy. You find different sources, albeit more expensive sources for the same goods. That gets plugged in. Sure, profit margins come down a little here, they come down a little here. You make it back up on pricing here. But this is on an upward moving trend. So will you make 7% more this year or 10% more this year? Depends on inflation and pricing power. Employees, they're still growing, looking for help everywhere you go. We need employees. We need skilled employees. We need educated employees. We need technology employees. It's a solid economy. We just hope that they don't do something stupid to mess it up.
But didn't something happen to where the workforce participation went way down?
It did.
I mean,
It's called the
for
Great
whatever reason,
Resignation.
There's a whole lot of folks that just don't go to work.
Yeah.
Yeah, but they're also not counted in that number, but.
Yeah, so there was a good, was it 5 million people quit?
With the cost of living being what it is, they may have to come back.
That's a very good point.
That's
I wouldn't
what's-
disagree with that. I wouldn't disagree with that at all.
That's what they're
Moved
finding.
them into that unemployment number, and then
All of a
unemployment.
sudden, the unemployment starts to go up when they start to raise their hand and say, I'm back in the workforce.
Uh-huh.
Then, now, at least as of today, though, they're still probably getting hired fairly quickly. But if that process slows down,
Yeah.
then it begins
Well,
to
that's
impact.
going to change. You're starting to see it now in the calls I get. The real estate market, you're losing a wealth effect in the market. That's having an effect now on the real estate market, the commercial real estate market. I mean, starting to see stable and prices coming down. So it's,
And,
It's
on
starting to
the
happen.
residential side, rates move up and suddenly
five and
The
a quarter,
average-
5.25 mortgage rate heading north. So, it's,
so there's still a lot of people that want to live in a home that don't. They're employed, they've been waiting, they're saving. If they didn't jump on it yet, they want to, but they're going to have to pay more.
I may not be saving fast enough.
Yeah. Savings rate jumped up nicely, and now it's back down, and you're going, that's America. We consume. Give us money, we'll spend it.
That's
you
right,
know?
up in
That's
COVID,
what we
we're
do.
allowed to, so, right up.
Yeah,
Well, great, well, Bill, I really appreciate it, as
Yes.
always, we always enjoy the dialogue and so forth, so. thank you.
absolutely.
Any additional questions from?
the international.
Okay,
Sure.
You had to ask.
Go ahead.
No, I did, because you indicated that you've been hiring international. Why do you do that? I mean, if you look at the kinds of companies you're talking about, they have very significant international exposure. As a matter of fact, many of them probably have higher sales overseas than they do here.
Some of them, yeah.
And with
absolutely.
the problems with currency now and the destabilizing currency, but I mean, what is the reason for investing in foreign companies if you can get the sales
Right.
by investing in a Johnson & Johnson
Sure.
or
You get the-
Medtronics? Or,
You get the sales, but do you get the employee base like China that has, 200 million 20-somethings that are educated, college educated, speak English, in the workforce, trying to grow, trying to better themselves and get into the middle class, and they are working for a lot less than they have to work, than we pay. And companies over there can expand rapidly at that pace, and companies over here are investing over there, not necessarily China anymore, in areas like it.
yeah, I mean, it's a communist
And
country, but they're
it's a
going to
global-
they're going to eat McDonald's and they're going to drink Coke and they're going to
Yeah. Right, and so what you have to think about is, there's not a lot of correlation between emerging markets, quite a few emerging markets, and the US market. So when a plan goes, why don't we look at emerging markets, they look at the correlations. And for a while there, in the financial crisis, correlations went to close to 1. Everything moved in tandem. And as economies start to spread out, you see the winners and losers.
The correlation built in equity values
In,
or sales?
in returns on investment over time, they go like this. And so when you look at China, if you had invested in China 20 years ago, it's like investing in Apple. It's growing like crazy. It's actually, how about a country that's growing at 12% a year or 8% a year compared to our 3%? It's a pretty good deal. Now, Russian equities, who would have thought? We had one stock. We were way underweight. And there's a valuation discount to those companies already. So the similar company with a similar profile overseas is trading at, 60% cheaper because of those issues, because of accounting differences. There's IFRS overseas. We have GAAP, or, whatever they're calling it now. And there's differences, and if you have people smart enough to go over there and actually talk to the company and get the real numbers, you can find out what's going on. If you think the small cap market here is inefficient, where managers like ours can make 3.5%, 4% a year annualized for 20 years, think about a foreign country where, like you said, currency risk, there's regime risk, there's 10 times more worries, but that means there's 10 times more opportunities to get it right and to find those companies that are growing, that'll be the next Baidu, that'll be the next, you name it. And it's tough because we know what's safe, and that's U.S. investing. Just like Canada said, oh no, we're not going to allow investing outside of Canada, we need to keep the money here. As soon as they opened it up, it was like their returns overall rose. It improved the wealth of the nation on the pension side, and that's leaving money on the table when there's opportunities all over the world. And Brendan has a lot more to say about that. He's much more versed.
It might not be a public company too.
What's that?
China next week might not be a public company.
People need to remember that.
We used to call that political risk. I don't know what happened to that.
That's almost a guaranteed risk. You don't know when.
There's another component of that, especially in this environment. The conversation we talked about, slower growth, stagflation, maybe recession here. And this Fed, and really not too many people working here have really been through a lot of inflation because we haven't had any for 40 years.
I had a 13% mortgage.
Yeah.
There you go.
But the rest of the world has. They've been dealing with inflation on and off. This is a discussion I was a part of just last week actually with someone else. But their point was, the rest of the world, although they're experiencing inflation too like we are, they've been dealing with it for a while. They're better equipped to handle inflation than the United States is. And so what their position was, international has underperformed domestic in part because of the strong dollar for so many years. We're going to struggle with inflation and higher rates. Eventually that's going to lead to a weakening of the dollar, a fairly significant one. And that's going to provide, they weren't trying to say it's going to last for 2 years, but a significant tailwind for international investments relative to U.S. Again, when you kind of combine that with our slowing growth and inflation, that was kind of the angle that they were saying. Just broadly speaking, they see a 5-year or a 10-year period of international doing much better than they have relative to the U.S.
Well, it is coming off a period of time where it didn't do much of anything.
Right,
Exactly.
relatively speaking, it's, yeah.
And usually that's a good time to invest.
Absolutely.
And you're getting it 30% cheaper on average.
Even though, we could have been having this conversation 5 years ago and been saying, international has been underperforming for a long time. We're probably, but here we are 5 years later. But
last year international did okay.
I just have my time horizon.
It has. It has. And we think it's just additive to our process too when you have, we're all based in Dallas. We do have people in Hong Kong and, the UK and Europe. And they do come to Dallas quite often, but pandemic taught us there's a thing called Teams, WebEx, you're right there. So it's additive, I think, for our firm to have that. We were already being asked, we were already managing like 5-6 billion in ADRs when we started non-US back in 2005. So that's a pretty good sized international manager without a product. So
I always
for
remember
us-
that day when Alibaba came to the New York Stock Exchange and Jack Ma was there, he looked like the happiest guy in the world.
It was.
And then they locked him up. You know, where is Jack Ma? You know? He started doing the moon dance and all that kind of stuff, and that thing was.
Well, very good. Again, Bill, thank you very
Yes,
much.
thank you. Sorry if I went over time a little bit, but it was always a great conversation. I very much enjoy meeting with you all, so thank you.
All right. Thank you very much.
Take
All right, safe travels.
All right, thank you.
While Bill is leaving, but we're still on, I'm giving him indirectly credit because it's in his book, but I just wanted to highlight page 13 of the report. You can see it up on the screens. This is something we've kind of been talking about for a while, but it shows the weight of the top 5 companies in the S&P is by a significant margin at all-time highs. So again, this just sort of ties back to some of the growth conversation and everything else, but I just, since they had it in kind of a nice clean chart, I wanted to just draw your attention to that. One other, just sort of, again, follow-up, he had mentioned fees, new clients. Do you guys, your average fee with Barrow Hanley is at 32 basis points, but you're at the fee schedule of every incremental dollar is at 25 basis points. So there's downward pressure as that account grows or what have you. Just, he was talking about that CID at 30, right, at 35. So I just wanted to mention
How
that.
negotiable is that? I mean, how long has it been like that, and typically?
It's been that way for a while, and I would probably argue it's not all that
Notice what he said
negotiable.
about the oil industry.
Right.
I like that dynamic.
For active management that's outperformed the way they have, to be essentially your incremental dollar at 25 basis points is pretty good. And I think you're kind of already at the sort of A+ institutional pricing. I mean, you can get a lot of fixed income portfolios at $5 or $10 million, you're getting at 25 basis points. To get truly active equity at that same incremental fee rate is very good, very competitive. All right, I know we've been going long. I want to draw your attention to a few different things. A couple charts just to really kind of touch on some of the conversation that we've already had. So I've got the big book in front of you, which is the quarterly. Really just talking about the growth and value dynamic on page number 7. You can see that chart in the upper right-hand corner. It's been pretty dramatic within the last quarter. And certainly the sector returns, which is on the upper right of page number 8, is wide. Energy and utilities are the primary driver of that. Obviously, this has been sort of a confluence of sort of a perfect storm. So when we were coming into 2022, it was inflation. Right? That was obviously the issue, and the Fed was going to be raising rates. Then that issue gets doubled down with, of course, Russia-Ukraine. You throw a geopolitical crisis on top of something that's adding a tremendous amount of inflationary pressure because what's happening with oil and wheat specifically. And so that's really going to be even more persistent. And then the other thing that actually hasn't been discussed a lot, but I'm starting to hear more about the COVID resurgence in China. Has been incredibly disruptive, just locking down Shanghai, which again is adding to the supply chain issues. Again, in the news you hear about Russia, but from an economic perspective, I think we're almost getting impacted more because of COVID and what's going on in China. So again, just all of those sort of factors, at play. And then if you flip to page 13, bottom right-hand corner, just talking about the yield curve. So the Fed has raised 2 times, and they've gone 3 quarters. Look at that 2 or 3 year number. We're up over 200 basis points. So one of the discussion points that we're hearing is, that the Fed has the market has priced in an additional 150 bips of increases. And this is as of the end of the quarter. As of today, it's actually a bit more than that. So as we sit back, yes, we have inflation. Fed is going to be raising rates for at least a few more times. Consumer is starting to slow, changing their patterns. Growth rates are starting to come down. You know, those issues are going to sort of meet in the middle. Is the Fed going to be able to raise as many times as they were intending, say, 4 months ago? Obviously, we'll have to see how the next few quarters and data points play out, but that's kind of one of the counterpoint to what Bill was saying. He said, no, there's just growth. He thinks everything is going to, you know, kind of power through, aside from the, you know, I'm hearing some other stuff about, you know, that sort of dynamic that there's at a little bit of an inflection point, that potentially we really turn more negative. And that gets back to, I don't know if anybody was paying attention, last week I think it was, both Target and Walmart announced. And the bigger issue, you know, the sales were still there. And wages are up, as we know, but so is inflation. So it's almost like a complete give back. You know, yes, you're making 10% more, but then you're spending 10% more on all your goods. So especially the lower end consumer, on a net basis, isn't really any better off. And then what Target and Walmart kind of specified is their sales were up, but instead of, and I'm making these numbers up, but instead of 50% being in household goods and sporting goods and electronics, which is where all their margins are, is shifting into grocery. So the grocery portion, which is a much lower margin, so that the spending is still there, but it ends up being much lower margin business. And that becomes the concern. If that, you know, spreads farther across the economy and lasts longer, then
Grocery's not here because Kroger took it.
Yeah. We sold puts on both, Target
Did you?
and
Okay.
and Walmart. 15% below the dip price.
right. So again, just some of the challenges that are kind of brewing within the economy. Which again, if you just step back and you look back over the last 10 years, it's not surprising that you're going to have some sort of issue. But all of these things kind of coming together has really intensified this sort of this drawdown, which, you know, we might have argued should have been 10 or 15%, but instead is now 20+%. Getting to the actual performance, and again, I guess I'll just comment on the quarterly. You probably had a chance. So 18, we underperformed overall. We're down about 5.7% versus the benchmark of 4.7, so about 100 bips behind. What's interesting, what you'll notice, well, U.S. equity was essentially in line. Now we outperformed on fixed and outperformed on real estate. The real deficit was in international. So that was a primary source of relative underperformance, along with asset allocation. So we've been overweight to equity, which obviously has really helped the last 4, 5, 6 quarters. But in this particular quarter, the international relative performance hurt, as did having a bit more equity than the market. I'm happy to go through these numbers, but it may be better to just jump to the April update.
Yeah.
Since it's more relevant and up to date. But I will say, generally speaking, in the April update, it's essentially the same story. Actually, a little bit better, so I'll touch on page number 4. Because essentially, we're in line with the benchmark, but down an additional 6.77%. Outperformed pretty nicely in domestic equity, fixed income, and real estate, under in international. And again, so if you just looked at the equity performance, you'd say, or excuse me, not just equity, but overall manager performance, you'd say we should have outperformed. But it's because we had a bit more equity that was down, 7%, 6%. That's why the total plan was essentially in line, even though the underlying managers on a net basis were doing better within the month. So with that said, let's jump into page 5 and kind of see that. Certainly some negative numbers here. Twin down 831 versus 891. Interesting, look at the last 12 months. They're ahead by 2%. That's been obviously a nagging issue for a while, but they've, especially the last 6 months, have really kind of turned the corner. And as they had mentioned, they will tend to do a little better when the market goes sideways or negative, and that's certainly proving out to be the case. Barrow Hanley, who you just heard from, slightly ahead for the month. And then really just that 1 year number, otherwise still very strong relative performance. Brown mentioned earlier, kind of talking about the concentration that has been an ongoing discussion. They were behind in the quarter for the same reason, that lack of concentration in those top names. But you'll notice they did slightly outperform for the month. And then Pzena and DGI, again, both negative, but fairly substantial outperformance for that relatively short period. Talked about International Silchester, just a little bit behind. Bailey Gifford has been really impacted significantly. And I think more than anything, that has, from a growth standpoint, from a valuation standpoint, that's the most aggressive part of the portfolio. And as interest rates are moving, being coupled with geopolitical risk, which, kind of the international flavor of it, you combine those two things, and they've been getting certainly hammered. Obviously, the long-term performance is there, but certainly the last 12 months has been incredibly negative. Again, don't view this at all in terms of an issue with the process. And it's really just the kind of the environment where valuations were supported up until 6 months ago. And now the market has said, no, we're not gonna support elevated valuations. So we're certainly seeing that come down pretty dramatically.
I think overall perspective, for 20 years at least, we've always had a high allocation to equities and under valuation bonds. And it's my opinion professionally that a lot of these bond losses over the last 6 to 8 months are probably a permanent markdown of capital. Unless interest rates go back to where they were at 120-year lows a year and a half ago, it's painful when companies get their prices temporarily knocked down, and we've experienced that before. But I think we've done strategically a very wise move in not having to book 40-50% of our portfolio at a permanent loss, which ain't coming back. Stocks can grow back, management can change, they can adjust their business model. You will never get an extra dividend from your bond fund manager because the Federal Reserve jacked up rates, much higher than, well, probably where they ought to have been, but it's in some long run, I think we've dodged an enormous bullet, and I think there's a lot of 60-40 portfolios that are going to, basically, they're not coming back on the bond side. So you're going to have to pick your poison. I think our poison is well selected.
Right. Absolutely.
And, no one likes volatility, but we've gone through it before. And, we keep going back to that drawdown chart on the S&P 500. And, you can't predict the future, but for every drawdown, there's been a decent recovery for the last 50 years, for the last 100 years.
And the innovation within the economy, especially in the U.S., is amazing. What's going on in the medical area, that will wind up transforming companies and how we live and so forth. It's not going to happen next week or next month, but you have a vibrancy underneath the covers that I think is going to eventually, things will work out a little bit better than the worst case scenarios. And I'm pretty good at cooking up worst case scenarios, so that's the professional hazard reality. But it's it's good, but it's going to be tumultuous. But I think for a perpetual firm, where I think we're as well positioned as you can be in a perfect world at the moment. So the staff and everybody else that we have to remind our trustees and participants that this is the price you pay for the exceptional returns we've had long run.
Some people look at bonds as an insurance policy, but the premium's way too high anymore.
Yeah, well, and talk about real return. Rates have jumped up pretty dramatically, but you're still getting only 3% on the 10-year when inflation's running at 8%.
Well,
And you just say the bond fees run about 35 basis points?
25.
Well, that's pretty stiff.
The average retail mutual fund bond is like around 68 basis points, which is
When you
that
consider
business
what
model
the,
can't last.
yeah, when you consider what the returns are.
Right. And likely to be impaired for
Yeah.
some time in the future. About the only positive that I will say for plans or for investors that are going to be in bonds. Now you're getting yield. You weren't getting yield 18 months ago.
You didn't know them,
Yeah.
now it's time to know that you want them.
Right, if you need it or you just care about the yield,
Correct.
but from a, total
Yeah,
return
but
type.
to build on what John's saying, why not take growing dividends?
Exactly.
Because the market's going down another 20%.
Right. Well, interestingly, to that point, so one of the discussions is, with the economy slowing, with inflation, Fed raising rates, do we get to a recession? Does that happen? On average, the market draws down about 30% around a recession. Well, we've already done 24%.
Yeah.
Well, it has that.
Yeah, so, obviously, average means some are better, some are worse. But if you follow that line of thinking that, even if we do hit recession, we've already sold off the vast majority, at least, of what that average pullback would be.
And the pullback, for a lot of those companies, are down 60, 70, 80%. It's
Yeah.
predictable. I mean, they had lousy businesses, and people were just morons to bid up the prices. And sorry, this is, fools eventually get their comeuppance, and so there's nothing unjust going on now. These companies never deserved the valuation they had, and now we're resetting back to reasonable. I think the more traditional companies that actually sell stuff that people want to buy and they can sell profitably, we're not going to be in a boom year, but years, but it's going to be okay.
Any other questions on kind of the quarterly or what we handed it or sent this out in the email packet? But I just wanted to touch on, this is not plan specific, this is just kind of general information, because one of the questions is, okay, in an inflationary environment, what does that mean? Does that mean, the market's going to implode? And so what this does is it looks at each calendar year from 1926 on, where the CPI year over year was a change of 6% or greater. And obviously, kind of the short version is it's all over the place. Some years are way down, some years are hugely positive. Obviously, in that kind of the low right, you get the average return. So generally speaking, markets are still positive in inflationary periods. The only thing I'll note, and I think you guys know this already, but you'll see the average return for bonds over all of these years is 2.8%. But if you focus on that column, or that row, along the bottom, the majority of these years were 1969 to 1981. And when you started with that interest rate or that inflationary period, rates were sitting at 7 to 8%. And they went from 7 to 8 to 14, 15%. So you had capital impairment, but you had enough yield to cover up that drawdown in value of the bonds. Now here we are today, even though rates have jumped up to 3%, they're still way below that level. So if you get any sort of continued interest rate movement like we saw back then, you're not going to see 2.8% positive on bonds. You're going to see something like -5 or something annualized. So again, just wanted to kind of frame that out, because I did have one person go like, well, geez, even in inflation, bonds are still making money, so that's not a big deal. Well, the environment's a little different.
On our operating fund investments, for a few years, we've been invested in money market type local government investment pools, which wasn't really my preference, but we had a previous city manager and finance director who thought they knew more about investing than they did. And but now we've kind of been freed up in what we can do again, and we are actually shifting into commercial paper and something inside a 2-year sort of callable agency investment grade corporate bonds, which there's still downside market value potential there, but if you hold a maturity, which we're going to do, you're not going to lose anything. You may have to report it as an unrealized loss on your financial statements at the end of the fiscal year, but I'm not concerned about that.
Interesting. Well, very good. Well, the one remaining, anything more for you? I always appreciate. Okay.
No, that covers it.
The one item that you mentioned earlier, the ESG, and again, we have some of our trustees are interested in looking at putting some screens on. We've had that discussion before. We don't think that's worked out in the past very well. I don't think it's going to work out well in the future. It looks like the intellectual weight of both the legal and what staff has done is beginning to sway, and maybe just educating our trustees in terms of what their responsibilities are and the impact that ESG has in the real world. I would like to suggest that we propose a motion that we're very supportive of staff's recommendation, as well as the current city attorney's position. And if you want to draft up a memo, and I prefer a unanimous vote if we all feel the same way, but I think it's important that we provide staff and city attorney with corroboration of our opinion that ESG hard screens, frankly, they're probably illegal and they're not in the best interest of the plant long run. So,
I'll make that motion.
got a motion?
I'll second.
Second. Any more discussion? If not, all in favor, please say aye.
Aye.
Noting that Dave did say aye, although I guess your vote doesn't technically count, so be it. It's a unanimous recommendation by the Pension Review Committee, and then I'll let you draft that recommendation as you see.
We'll draft a memo and we'll bring it to the PRC meeting in June.
Perfect.
The next Finance Committee meeting for the City Commission, they've moved it to quarterly. It used to be monthly, which was a bit burdensome, but quarterly is easier to deal with. So I'll be going back to them in August with, some of the information like what Bill had showed as far as what they're screening for ESG, and we would include the memo at that time to the committee. But we'll let you take a look at it and approve it in June.
And as I mentioned before, and if it's helpful to have either myself or other members that want to participate in a discussion with the commission, if I'm available, I'll be more than happy to.
If some sort of action is taken through the Finance Committee to refer this for consideration to the full City Commission, that would probably be the time to come and speak, and we'll keep you apprised of that.
One of the things that's kind of interesting, when you think about ESG, and you think about how deep regulation runs in this country on environmental matters. I mean, there's a federal environmental protection agency, there's a state environmental protection agency.
County environment.
There's in terms of the other governance and things like that, the Labor Department regulations. I mean, there's an enormous number of regulations that already compel at least American government companies to be heavily regulated with respect to ESG. And you'll notice, by the way, that California statute that mandated a minimum number of women on, it's been reversed.
Yeah.
So those kinds of things are all very volatile right now. But we do have a very established regulatory regime in this country that does address ESG.
And the managers are looking at it as well. And if the factors are important enough, they're built into their analysis.
And one of the other challenges about the kind of the top-down mandates is what qualifies as ESG is very subjective. So what set of criteria are you going to apply? Like, Barrow Hanley has one set that they're applying, but I mean, at a plan level, if we were going to impose that set of restrictions, what set of restrictions are you going to use? Because there's a lot of arguing or discussion about what metrics are most important.
And it could be a lot of virtue signaling, that people are hiring people.
No, that wouldn't be the case.
Well, I wish you had said it. But it's going on in so many different things, and now it's happening here. All I could think of was the cost that's being incurred for their ESG programs.
That's right.
Well, very good. Well, we've gone, any other items? Maybe with staff on me, then again, as always, thank you guys. I appreciate everyone's participation. The discussions are always really, I always find it very energizing, and I appreciate the work everyone's doing here. So if there's no further items, I'm going to go ahead and conclude the meeting.